Welcome back. As promised, we're continuing a conversation with the earnings analysis for many of the financials. The Shriram finance stock is still down 8%. And this is after an 8% decline. These numbers, remember, came out just as the market was closing out on Friday. So there's a big slip that's come through. Now, what is the market's concern? There is a large write-off that Shriram did in the quarter gone by. There is some pressure on the margins and some issues around asset quality. So let's clarify all of that and more. We have, of course, our next guest joining in. Thank you, sir, so much for being with us. So, like I said, the market needs a little more clarity on the write-offs that you've taken, your credit cost estimates, and what's really happening with asset quality. So, Mr. Revankar, sir, if you could just start right there. With these write-offs, I mean, the gross NPA level has come down. Are you intending to take more write-offs? And what is the guidance on credit cost? Are you seeing more stress build up?
No, it was a policy decision taken at the board meeting that where we already provided for, we thought for accounts not performing more than 12 months to be written off. So that's a one-off, and I don't think there will be further anything. We just wanted to go forward with those accounts, and the recoveries are still on. It is not that there's no recovery on that. Every quarter we have recovery, and as and when recovery happens, it will become the income part of it.
Sir, can you give some guidance that would help? I mean, what is the kind of recovery, whatever visibility you may have looking at the book right now, say over the next 1 or 2 quarters, and on credit cost as well? I believe it's at 2.42% right now. If you could just clarify, and where do you see this number of 2.42% moving?
See, we have been giving a guidance of around 2% plus or minus 10% on the credit cost, and we are at 2.07 as far as Q4 is concerned, and for the full year it's around 1.92. So we are within the guidance on the credit cost for the whole asset. And going forward also, next couple of quarters, we don't really see any challenges. The market is good. The rural demand is quite good. And the rural economy is also doing well. So we are quite confident the credit cost will be maintained at the present level.
Mr. Revankar, good morning. Prashant here. Good to see you, sir. Is this increase, though, led by some specific geographies? Could you give us a sense of what we've seen? It's one-off, and maybe some recoveries will happen. But the underlying, is it rural is better, but urban seems to be a little slower? Across companies, commentary. I mean, I'm sure you've heard the Maruti management talk about that 2 days back. We just heard from Chola earlier. So give us a sense, what's happening.
No, overall, the economy is doing quite good. I don't really see any pain anywhere. Some geographies, as you rightly put it, central part of India, there were certain challenges in the rural area. That now the rural markets have improved. I don't think there is any further challenge. It is already addressed. The Rabi crop is supposed to be bumper. It will definitely help the rural credit demand and the rural credit quality to improve further. So I don't really see any challenges. The urban is a little slow because the infra spend has been slow by the government for the last full year. I think the infrastructure projects are coming back, and next financial year we should do well. We expect the demand from both urban and rural to go up, and credit quality to remain stable.
Hi, Mr. Revankar. Good morning and good to see you. Let's focus on the gold portfolio. It's a very small part of your business, but we just had a peer who, was just telling us about his foray, Chola's foray into gold. For you, as a percentage of your book, it's small, but you've seen a degrowth out there. Why is that? And could you tell us what plans you have on this vertical going ahead?
See, the gold AUM has some degrowth, but if you look at the Q4 disbursements, they were higher by 20% Q on Q. So we are back into gold. We will be growing the book in the next financial year, and we will keep growing. We are also adding more branches to the gold network. It requires certain reskilling and re-engineering the process, which we have already done. So here on, we'll keep growing the gold book.
Okay, all right. So then since you briefly spoke about growth, you are guiding for mid-teens growth. So could you tell us segment-wise what kind of growth are you looking at for the year? And particularly, are there signs that the CV growth is petering out a little bit, or do you believe that it's pretty much in fine fettle?
We still believe that CV growth is continuous and it will keep continuing to grow. Maybe between 12 to 15%. Last year also we had given the guidance of 12 to 15%. We grew by 14%. This year too, we believe it will grow in similar lines, even though the sales have been flat, year on year have been flat. And it's mainly because the infra spend coming down, bulk material transportation, which is dependent on CV. And whenever there is a slowdown in steel and cement bulk material transportation, the CV demand comes down. However, we still feel there is a shortage of vehicle on the road, and there is a full utilization of vehicle. The repayments on the vehicles are very good. So we continue to believe that demand will come back into CV, and the used vehicle market will grow faster in the next couple of years because the sufficient number of used vehicles are coming into the market now, because the new vehicle sales started 3 years back and it will come into the market. So we believe overall there will be a growth going forward in the CV. Passenger vehicle will grow faster at more than 20%. And of course, MSME gold also will be growing. We will be growing 20% plus. So broadly, I can say that CV and construction equipment will be growing between 10 to 15%. And the MSME, passenger and gold and two-wheeler will grow at 20% plus for the next.
Overall 15%.
Overall 15%, yeah.
Mr. Revankar, on margins, what can we expect, sir?
So margin, we have given the guidance of 8.5. We should go back to 8.5. The last quarter's 8.25 was because of higher liquidity which we are carrying. Let's see, we have been looking for raising long-term resources in the international market. We did have raise certain long-term resources which has a maturity of 7 to 10 years. And since we need to really plan for it, we did raise that money at that time. And that will be utilized in the next quarter. So we will be able to manage our excess liquidity within the control, within the 3 months normally, which we keep. Now it is around 6 months. Next 2 quarters, it should come down to around 8.5 level, net interest margin, go up by 8 to 8.5. And we should be able to maintain at 8.5 for the full financial year.
Okay, so margins should recover to 8.5, which is where you were in the third quarter. Q4, it dipped a bit, but you're saying it'll go back to 8.5 and sustain there. Got that point. Sir, on gold loans, just to go back, I mean, you gave us a whole breakup, how you were arriving at the 15% AUM growth expectation for the year. On gold, really, what's going on? We were just discussing this with Mr. Selvan, when one of your peer NBFCs just earlier. They're also getting into gold loans. It's a very exciting market, it seems. But what's the situation on ground? Is there too much competitive intensity? And the RBI obviously is looking at it with hawk-eye. And some sense of the growth. I mean, how do you come back to growth? Will it be Q1, Q2? And for the full year, what do you expect from your gold book?
Now, if you really look at how the gold financing happens, more than 50% of the gold financing, I still believe, is with the pawnbrokers and the unregistered lenders. So there is a huge scope and opportunity because people would like to walk in to nearest place, nearest pawnbroker or jewelry shop for raising money. That's how it happens. So the kind of holding Indians have the gold is one of the highest in the world. So if you are able to plan it well, if you are having a branch network and contact with the customer, then we'll be able to grow the gold. So there is enough scope and opportunity for gold financing. And especially at the time when the gold prices are going up, it's an extremely safe lending opportunity for us. And also to the existing customer of ours. There are many SME customers, two-wheeler customer, any customer for a small requirement, temporary requirement, a working capital requirement, he can go to the nearest office of ours and raise money. So that is the opportunity.
Yeah, it's a very powerful sort of instrument now with gold prices being where they are at the hands of the borrower, which is why just trying to get an estimate. Full year, what is your AUM target for gold loan growth?
See, we are at around 5,500 crores. We are planning for a growth of 20% plus. We should reach around 7,000 to 7,500 crores in this financial year.
All right, Mr. Revankar, thank you very much, sir. Good speaking with you. Thank you very much for joining us with those details. So 15% growth, credit costs 2% plus minus 0.5%, margins about 8.5%. These are what Shriram is aiming to do as we look ahead into FY26.
Interesting because the stock is trading at very juicy valuations, at the start of today and post the 7% downtick as well. If you look at it on the price to book or PE or even the return ratios. But for the timing, 15% frontline name getting a hit like that, in a couple of trading sessions, it's a little bit worrying.
Hearing him, you wonder whether 15%,
because
where's such huge concern coming in? Because
management
doesn't sound so concerned.
The entire story of Shriram got re-rated. It was a merger, right? It was Shriram Transport Finance, Shriram City Union.
Yeah.
Transport Finance was lumpy. City Union was kind of stable.
Smaller business,
but stable.
Stable, yeah.
So that provided stability. And the business started re-rating 2 years back. Otherwise, it always used to be the cheapest, by far the cheapest NBFC.
Indeed.
So I don't know if the market is making too much of it. And it's not, because on Friday it was down. And I think, as you guys said, over the last 2 weeks or so, it's down 13-14%. So it's actually the first hit we've seen in many quarters on the asset quality side.
I think on the valuation parameter, if you compare it with Chola, it's trading at 50% discount in comparison to it. So it's trading, I think, at around 1.5, 1.4 times or thereabouts.